Welcome to The Explainer. Today, we're diving deep into the world of internal auditing, specifically unpacking Samai Herakli's lecture on day 24, which covers the Revenue Cycle Audit. If you've ever wanted to understand exactly how a business secures its absolute lifeblood, its cash, and how auditors make sure that entire process is totally foolproof, well, you're in exactly the right place. Let's get into it.
So here's our game plan for today's Explainer. We're going to move chronologically through the material. We'll start with some foundational definitions, walk step by step through the process and key controls, look at a real transaction, and finally, wrap up by examining the real-world impacts and those pesky red flags.
But before we get into the weeds, let's look at the complete roadmap and really establish our North Star for this whole analysis. At its core, the Revenue Cycle Audit focuses on evaluating the processes and controls involved in generating revenue and, crucially, actually collecting that cash from customers. Ultimately, our main objective here is to ensure revenue is recorded accurately, completely, and right on time. That single foundational goal is going to drive absolutely everything we talk about today.
All right, moving into our first major section, let's lay down those baseline definitions and risks that power this entire audit process.
So what exactly is the revenue cycle anyway? Simply put, it encompasses every single activity from the exact moment a customer places an order all the way to the moment the cash is actually collected and recorded. It's not just making a quick sale, right? It's the entire journey of that transaction. And this is a massive deal because it directly impacts financial performance. I mean, without revenue, there's no business. Because it's so critical, it carries a remarkably high risk of errors, fraud, and revenue leakage. Just think about a super busy retail store losing track of unbilled inventory right out the back door. If this cycle isn't completely tight, your value just literally leaks away. Now, as auditors, what are our main goals when looking at this cycle? First off, we absolutely have to ensure revenue is recorded accurately and completely. Second, we verify the existence and valuation of receivables, basically making sure the money people owe us actually exists and is worth what we claim it is. Third, we need to guarantee proper authorization and documentation for every single transaction. And fourth, we evaluate the effectiveness of the controls in the process. A really practical example of this is when an auditor checks to make sure a huge credit sale corresponds to a real, fully vetted customer, not just some phantom account created to artificially inflate the numbers.
Of course, a process this critical definitely has its pitfalls, so we have to actively hunt for several major risks. The first one is revenue either not being recorded at all or recorded incorrectly. Next, we're looking out for unauthorized pricing or discounts. Third is the risk of inaccurate billing. Fourth, we watch for fraudulent sales or fictitious customers. And finally, and this is a big one, inadequate segregation of duties. Imagine just one single rogue employee having the power to both approve massive discounts in the system and then physically collect the cash. That is a total recipe for disaster, and it's exactly the kind of nightmare scenario this audit is designed to prevent.
Now for Section 2, which is where things get really interesting. We're moving out of the theory and diving into the actual physical mechanics and step-by-step flow of the cycle itself. Let's walk through a classic order-to-cash sequence, starting with the first 4 steps. Step 1 is the customer order. The customer actually places an order for goods or services. Step 2 is the order review, where we check the order against credit limits and availability. Step 3 is shipping or service delivery. The goods go out or the service is done. And Step 4 is billing, where an invoice is generated and sent over to the customer. To put this in perspective, imagine you're supplying bulk steel to a huge construction firm. Before you even think about loading those heavy trucks at the dock in Step 3, Step 2 requires a rigorous credit check to guarantee that client can actually foot the bill for hundreds of thousands of dollars in material. Okay, so the invoice is out the door. The cycle keeps moving. Step 5 is cash collection. We receive the payment from the customer on time. Step 6 is receipt recording, where we actually log that receipt into the accounting system. Step 7 is bank deposit. We deposit the cash into the bank and reconcile it. And finally, Step 8 is AR, or Accounts Receivable Reconciliation. This is where we reconcile customer accounts and chase down any outstanding balances. We are making absolutely sure that every single dollar from that massive bulk steel order hits our bank account and matches up perfectly with our internal records. Let's pivot slightly and look at this from the auditor's perspective. How do we actually test these mechanics to know they're working like they should?
Well, to keep all those risks in check, auditors evaluate a very strict checklist of key controls. We're checking for proper authorization of credit and pricing, careful review of customer master data, the precise matching of the order, delivery, and invoice, and timely, accurate billing. We also check segregation of duties,
timely receipt recording, bank reconciliations, and regular reviews of accounts receivable. In plain English, evaluating these controls means making sure the guy responsible for updating customer master data, like changing a shipping address, is absolutely not the same guy who can alter the final invoices.
So how do we actually do the heavy lifting to test these controls? An auditor first has to fully understand the process and flows, evaluate how the key controls are designed, and then test their operating effectiveness. This means doing walkthrough testing and substantive testing, which involves things like vouching, recalculations, and confirmations. Lastly, we review the reconciliations and aging reports. Practically speaking, performing substantive testing like vouching means you take a sample invoice from the system and physically trace the entire paper trail backwards, all the way to the original shipping dock receipt, just proving that the transaction is 100% real from start to finish.
Section 4. This next part brilliantly illustrates why we need to look at a concrete, real-world transaction to see how all these concepts actually tie together.
Let's trace a textbook perfect scenario. We've got a customer, ABC Private Limited. The order is placed on May 10th. The goods are delivered on May 12th. We see invoice number INV 1456, also dated May 12th, for an amount of $50,000. Finally, the payment is received on May 20th. When the auditor reviews this specific transaction, they're confirming the order was approved, goods were delivered, the invoice matched up perfectly, and the payment was accurately recorded and deposited. Everything aligns perfectly, leaving a clean chronological paper trail.
All right, moving to our final section, we're going to land the plane by looking at where things go sideways and the massive overarching benefits of getting this cycle right.
When auditing this cycle, you've always got to be on high alert for common red flags. We're talking about large or highly unusual write-offs, a weirdly high volume of manual adjustments, or strange delays in billing and collections. We also hunt for duplicate customers or invoices and inconsistent discounts. For example, if you're analyzing a company's data and suddenly, out of nowhere, you see massive manual discounts being applied at the very tail end of a financial quarter, yeah, that's a glaring red flag. A lot of times, that means someone is artificially trying to hit their sales targets by just bypassing the standard pricing controls entirely.
But when a company gets this right, the payoff is huge. An effective audit leads to incredibly accurate financial reporting, a massively reduced risk of fraud and errors, improved cash flow, much stronger customer relationships, and tighter compliance with laws and regulations. At the end of the day, this isn't just about checking compliance boxes. A rigorous revenue cycle audit can literally save a business from sudden, catastrophic cash shortages by ensuring the money they've earned is money they've actually collected.
If you only take away one core truth from today's explainer, make it this: a well-controlled revenue cycle ensures that the right amount of revenue is recorded in the exact right period, and that cash is collected and reconciled properly. The internal auditor's job is simply to make sure those controls are adequate, effective, and consistently followed. It all boils down to a very simple formula. Strong controls in the revenue cycle equals reliable financials, plus reduced risk, plus better overall value. It's really that simple, but so incredibly vital. Which leaves us with a pretty provocative question for everyone watching. When you take a hard look at your own company's systems tomorrow morning, are your revenue controls truly protecting the bottom line, or are you leaking value without even knowing that?